Now I got to go live to the trading desk. I've got Victor Adair. First off, Victor, thanks so much for hosting last week. Tremendous job.
Well, thank you, Michael. It was a lot of fun.
Yeah, you find out you get a great guest. Doesn't it make it easier?
It makes it a lot easier.
Earlier on today, you had Dennis Gartman. Man, I just sit back and they do all the talking.
That's right.
Let's start with Vic. I thought, I don't know. September feels more like the new year than January. Tell me what kinds of stuff you're looking at, like your theme right now, or the sort of premise you're operating under.
Okay, I would say that we see it as a low growth, low interest rate world, and that's caused investors, and I'd have to say put investors in quotation marks, to reach for yield more than we think they should be. That reaching for yield has certainly been driven by or encouraged by various central banks around the world, and when the central banks signal that their policies are going to continue, then the market just goes out and reaches for yield again. So I guess our view then would be that all of this reaching for yield has caused many assets to become overpriced and risk in the market to become underpriced. That's just kind of how we see things out there. And, this isn't so much a day-to-day thing, but a bigger picture. So what we're doing is to take positions where we think that there may be a little upset to that complacency, and we could see, let's call it capital rush for safety. And in that kind of an environment, the U.S. dollar would do better against other currencies and commodities. You'd see better quality credits, gain money while junk lost money. And we also think that leverage would come out of the system. So we think the market's a little complacent here, and we're looking for that to change.
The big market that I worry about that people are going to get killed in, if there's a shift, and I'm not sure, I'm not seeing signs of it. It's something a couple of weeks ago on this, and that's interest rates.
Right.
I mean, I look at those U.S. Treasuries. It's making me nervous because that is such a massive shift. What has it been, Vic? Has it been 35 years or something? We've been in sort of the bull market when it comes to bonds?
Yeah, 35 years ago, the 10-year Treasuries in the United States were yielding about 15.5%. Now they yield about 1.5%. I mean, it's been a huge bull market in bonds as bond prices rise, as yields fall. And one of the bond kings of the world, Jeff Gundlach, came out here and said he thought that the bond market, bull market, they've been carrying on for all these years, ended in July of this year. Interestingly enough, the yields on the U.S. Treasuries hit their all-time lows just after the Brexit vote when everything was panicking. Gold jumped to $100, that sort of thing. Stock market fell off sharply. And since then, we've seen long-term interest rates rise a bit. We'll see. And that would be the 800-pound gorilla because everything in the world is priced off of what interest rates are.
Yeah, I don't, I'm not professing to know this at this point. I'm just saying this is one market I want no part of anymore. I mean, yeah. I want to make that clear for people listening. I mean, you've got financial advisors, listen to them. I'm saying Mike Campbell's sitting here and saying there is no risk reward for that market for me any longer that I'm willing to take. So hence I exit and I move that money really short term.
Let's just take 30 seconds here. I'm going to define risk as I see it. What risk is the possibility that you could lose a lot more money than you were thinking you were going to lose, in a worst case scenario. And you go, oh, okay. And if there's one thing, I guess, that has been hammered into me over the 45 years or so that I've been trading markets is I really, really try to respect risk. I know I don't know what's going to happen in the world. What I want to make sure is that if something happens in the financial world that's like outside my imagination, that I don't get clobbered. That's the most important thing to me.
Yeah, I'm not looking to be thrilled at making 1.5%, but I think I'm risking a hell of a lot more than that when I start looking at 10-year bonds and that kind of stuff. So, again, I'm just saying that's me because I'm exactly what you just described. I don't know what's going to happen. I just don't like the looks of it.
So, we kind of grind along with our short-term trading accounts just here at the end of the week. And this past week, of course, we had both the Federal Reserve and the Bank of Japan come in, rock and roll markets a bit. At the end of the week, we are long of the U.S. dollar against Canada and the euro. And in a quick sidebar to me, I think the euro is just a disaster waiting to happen, and Dennis Gartman explained it so eloquently last week. We're short of crude oil, and that's just a supply-demand story. We're short of gold, and that's I'm going to make that point as I did last week. That's paper gold, not physical gold. And we've got some small short positions here in the stock market and treasuries. The stock market seemed to get, to me, too high after the Brexit. We've had a little break here at the beginning of September. I think if we start to weaken, we could drop off 10% in the stock market.
Good stuff. There'll be no shortage of things to talk about. And once again, Vic, thanks so much for hosting last week. Great job.
Well, you're welcome. Thanks, Mike. Thanks for inviting me to do that.